Now, if you're like me, or if you're like anybody, you don't want to be overpaying in taxes. That's your money. That's your hard-earned money. And although I am a firm believer in taxation because there are many things we enjoy the benefits of, like roads, water, electricity, it doesn't mean I want to pay more than I am legally required to. And so when you're thinking about that, here are 6 clear signs that you may be one of those people that is paying just a little bit or even a lot bit more than you need to in taxes. The first is at the end of the year, or rather next year, right? You file your taxes and you tell your girlfriend or your boyfriend or your husband and your wife, honey, I'm so excited. I just got a big refund. Well, the reality is that a large refund means you overpaid the IRS throughout the year. And essentially you are giving the federal government an interest-free loan. And so if this happens year after year after year, how do you go about fixing it? Well, you're going to want to adjust your W-4 withholdings to increase your paycheck and use the money to pay debt, to invest, or to otherwise save. Another one, well, maybe you are filing under the wrong status. Are you a single parent and filing as single when instead you should be filing as head of household? If you do that, this error is reducing your standard deduction and increasing your tax rate. If you're one of those people who's saying, oh gosh, Luke, you're right, I've been doing this the whole time, well, you're going to want to work with a tax professional to ensure that you are selecting the most advantageous status each and every year. Now, all of us hopefully have some bit of savings, some investments. And so are you just going about selling them without any strategy at all whatsoever? If you are, you could be selling these investments and incurring gains and therefore taxes that you might not otherwise need to. Short-term capital gains are taxed as regular income, up to 37%. And investors often miss opportunities to do tax loss harvesting or Roth conversions during low-income years. That's why you need to fix it by always reviewing tax consequences with an advisor or a tax professional before selling or converting massive amounts of assets. Now, if you have a brokerage account, that's great. But maybe the mistake you're making is ignoring tax-advantaged accounts. Contributing to your brokerage before maxing out your IRA, your 401k, your HSA leads to higher income taxes now and later because you're missing out on tax benefits today and potentially tax benefits tomorrow as well. And so you're going to want to prioritize diversity. Diversity not just in how you are allocating in your portfolio, but also diversity in how you are investing in various tax accounts. Maybe you got a business, maybe you have a side hustle, and those have some levels of expenses. Well, many people fail to track phone bills, supplies, mileage, home office use, gas related to those jobs. And so if you fix it by documenting all the work-related costs and consider opening a solo 401k or a SEP IRA, you can help reduce the taxable income from that side business. And lastly is not working with a vetted tax professional. Do-it-yourself tax filing often misses the big savings opportunities. Now, for most people who may have one job and a couple investment accounts, do-it-yourself can be the cheaper alternative, right? Maybe you don't have a very complex tax situation, but that's not the case for everyone. So if your tax situation is a little more complicated, find a tax professional who understands your specific situation, meets with you quarterly or every half a year, and helps create a tax or helps improve your tax situation for you specifically. Avoiding these mistakes can keep thousands of dollars in your pocket each year without bending any of the rules.